So there's a formula generally, right, for calculating your ROI, and you kind of touched on that, and it's basically you take the value of the investment minus your cost, right?
Sure.
Or your down payment, as the case would be, and divide it by the cost of the...
Right, so the return on equity formula would be what you just described. The return on investment formula would be, I guess it's basically the same.
Yeah.
If you don't leverage, they're essentially the same.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old-fashioned real estate advice.
Episode 20.
Hello, and welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holst.
My name's Brian Leverage.
Yes, it is.
Yes, it is, Jeff.
All right.
Echo.
So we're very excited to talk about a topic today that's a little bit more involved than some of them that we've talked about. We're going to talk about...
something a little more complex, return on investment, or ROI, as most of you would know it, versus your return on equity, or your ROE. And there's actually a pretty big difference in understanding these, isn't that right?
That is true, yeah. So the simple definition of the two is your return on investment is going to be whatever return you get on the amount you invested. So if you were to buy something for $1 and sell it for $2, you'd have 100% return on investment.
Yes.
And in that scenario, your return on equity would also be 100% because you were not using leverage. And so you would have a return on investment that was the same as the return on equity.
So there's a formula generally, right, for calculating your ROI, and you kind of touched on that, and it's basically you take the value of the investment minus your cost, right?
Sure.
Or your down payment, as the case would be, and divide it by the cost of the...
Right, so the return on equity formula would be what you just described. The return on investment formula would be, I guess it's basically the same.
Yeah.
If you don't leverage, they're essentially the same. So just to sort of talk about where it becomes important to think about these things is when you're talking about calculating your cash-on-cash return. So in order to do that, I've kind of come up with an example. So in our hypothetical example, someone bought a house for $50,000 5 years ago.
Sure.
Okay, and it's currently worth about $75,000.
Yeah.
Sounds about right.
Yeah.
If they did that. It rents for $1,000 a month, which is pretty good for a $75,000 house or a $50,000 house.
Especially right now, yeah.
Yeah, and the expenses are about $400 a month. And this person owes nothing on the property.
Sure, no debt.
Right, so that's what we're going to start with in our hypothetical scenario. So they have a cash flow of about $600 a month. That's $1,000 minus the $400. Okay, so when we're calculating return on investment, we would take the current value of the house, $75,000, and we'll say they sold it for $75,000, and forget about cost of sale and everything. Let's just say they got $75,000. They paid $50,000 for it. So the way we would calculate return on investment is we would take $75,000, subtract the cost, and we'd have the gain, $25,000 gain, and we would divide that by the original cost.
50%.
Right, so $25,000 divided by $50,000 is 50% return on investment. And in that scenario, because they didn't finance it, their return on equity would be the same because their equity is the purchase price in that scenario. Now, where it becomes, I think, more important to think about this difference is when you're financing or when you're looking at like a cash-on-cash return.
Yeah, exactly. I mean, past episodes we've talked about leverage and, when to use it.
Episode 9, in fact.
Exactly.
Right there.
Right there. So, but when you do take on debt, and if we're being honest, most people finance their real estate acquisitions using some type of debt structure. It could be private money, it could be traditional bank financing, etc. That's where the return on equity comes in. And why don't you go into a little more detail on that?
Sure. So, return on equity in a situation where, if you don't mind, I'm going to step back one little tiny bit and talk about the cash-on-cash return first because I think it's helpful. So in our scenario, the cash flow was $400 a month.
Yeah. $4,800.
Right, $4,800 a year. And if you bought the property for...
actually, it was $600. So
$600. Yes, sorry. Yeah, the expenses were $400. So
we're not math guys,
$7,200 a year. Thanks. That's going to make the math a lot easier since I've already calculated it based on the $7,200. So if you had $7,200 in annual cash flow and you paid $50,000 for it, you would take $7,200, divide it by 50, and your cash on cash return would be 14.4%.
There you go.
Which I know because I use those numbers on this paper that I have in front of me.
The answer's right there.
That's right there. Now, if on the other hand you were to think about return on equity, right? You would say the same $7,200 in cash flow, but now you're going to look at, instead of dividing by the purchase price of $50,000, you're going to divide by the value, the current value of $75,000, which means that you're going to have if you take $7,200 divided by $75,000, you're going to have a return on equity of 9.6% annually. So you can see why those numbers are, they're calculated differently. And on one hand, you might say, why do I care, right?
Yeah.
Like, I'm still getting $7,200 a year. I still spent $50,000. Well, the reason you care is when you're comparing one property against another, it's the total value that matters, not what you paid. And in fact, if the price of the property were to go up to $150,000, right, then your cash flow was the same, then your return on equity would be half as much, or 4.8%. Yeah. So, and in that scenario, you could potentially refinance and take some of the money out, or sell and go buy something with a better return on investment or equity. So that's, I think, the sort of basic idea. And we kind of alluded to this, but we did do an episode 9, about leverage. And if we were to take this same fact scenario and we were to throw leverage into it, say 20% down payments, you could buy 5 properties instead of 1. I did some fancy math here, but if you had a 20-year amortization, 5-year interest rate, the payment on $40,000, which granted might be difficult to get that loan on a $40,000 property, but the payment would only be $264.
Yeah.
Well, $263.94, but who's counting, right?
It's a rounding.
Yeah.
Yeah.
Anyway, so your cash flow would go down in that scenario to $336 from $600, or $4,032 a year versus $7,200 a year. But because you would have 5 properties, your actual cash flow would be more like $1,680, because you'd have $4,032 times 5, or $20,000 a year in total cash flow, or $1,600.
Right. Yeah.
Which that's the leverage episode. But the reason this is important is because when you look at return on investment under a leverage scenario, your cash flow for that one, your one property, right? Or really, if you think about the fact that you could sell that property still for $75,000, now you owe $40,000 on it, right?
Yeah.
Theoretically, but you only put $10,000 in, right? So your $10,000 turns into $35,000. So your return on investment is actually 350% versus the 50% that it was if you didn't leverage it. Yeah. So it's significantly better. And of course, your cash on cash return, it's the same thing, right? So your cash flow went down to $4,032, but instead of dividing that by 50,000, you're now dividing it by 10,000.
Yeah.
So you're gonna have like a 40% cash on cash return.
But if you hold it longer,
then it's... This is where the cash on cash return doesn't actually change if you hold it longer, but the return on equity does change if you hold it longer, because the value has gone up, right? And also your debt value has gone down because you're amortizing it. So when you first start out, the return on equity and the return on investment is going to be exactly the same. Yeah. But if you hold it for 5 years and the property is then worth $75,000, like it was in our scenario, and then you have $4,032 in cash flow, but now instead you have somewhere around 35. Well, actually, with amortization, it would be like $44,000 in equity. You would divide that out, and your return on equity is dropped to 9%.
Yeah,
still not bad, right?
Yeah.
But what about at 10 years, right? Or and you only owe $20,000.
Continues to go down.
Yeah, and then it's going to be like 5% or something like that.
So really, it's a useful tool for evaluating what your holding period should be from a time frame, right? Because the equity doesn't really do you any good unless you find a way to tap into it through either a refinance or a sale, perhaps.
That's right.
And it's essentially not to oversimplify it, it's almost like an interest earning interest, right? So that sort of represents your profit, but it's not working for you until you're able to put it into something else.
And of course, you're going to have appreciation based on the total price, but the more property you control, the more appreciation you get. So if you were to refinance at 5 years and take out $20,000, right, in our scenario, you could theoretically go buy 2 more $50,000 properties with that. Or one $100,000 property, and then you're going to get the advantage of that additional leverage. And again, we covered that in much more detail in episode 9, but where I think it's really important is thinking about what your return on equity is going to help you determine when it makes sense to use leverage and when it doesn't. So do you have any additional thoughts on that?
No, why don't you tag all the things people need to go, our Facebook page, YouTube, old-fashioned real estate. .com,
yeah,
/ old
right, at Old Fashioned Real Estate at Twitter, Facebook.com / Old Fashioned Real Estate, BrianLeverage.com. No, wait, he doesn't have one of those. You should get one of those, actually.
Working on it.
Yeah, no worries. And also, you might have seen the new shirts.
Yeah.
What do you think of that?
Yeah,
pretty good.
I want to thank our partners.
Yeah, so Pro Logo Depot, right? Pro Logo Depot does this for us, and we're gonna have. Probably by the time this episode comes out, it will actually be available for purchase.
Be able to go on our website.
On our website, yeah. So we'll definitely tag that in the show notes so that you can find it. But otherwise, it's oldfashionedrealestate.com, and hopefully, once you get there, it'll be pretty obvious how to find the store. If not, we obviously will have to work on the website because you want to make those things obvious. And just as a personal note here, we really appreciate your support, and we'd love it if you would like and subscribe to the show and share it with your friends and family and people you don't know.
And their friends and their family.
That's right, because we would really like to have...
Yeah.
Well, when we started out, in one of our first episodes, we said we had tens of listeners.
Yes.
And then the next one, I think you said we have teens of listeners.
Yes.
Well, now we have hundreds of listeners, but we would really like to have...
thousands.
Or even millions of listeners. So if you know a couple of million people that want to subscribe to our show, we would be really happy to have you do that. So
we appreciate you joining us again. Look forward to seeing you again in the future.
Cheers.
Cheers.